What's going on, guys? This is Chandler Smith, and today I'm gonna help you to find the perfect home loan for you and your family. And I know there are tons of options out there, from FHA to VA to conventional to unconventional, and the list goes on and on. And the reality is, the goal of the bank is to push you into a loan to where they can make the most money. And so the goal of this video is to help you find the perfect loan without getting taken advantage of. So with that being said, let's jump into it. All right, now to get started, my brother just got his offer accepted last month on his dream home. And so right away he called me and said, Chandler, what do I need to do to find the right loan for us? And what all is going to be involved? How do I go through the process? What am I looking for? What loan is good? What loan is bad? And so he was consistently calling me with a bunch of questions that, let's be honest, even the bank that you're working with when getting your loan doesn't always help with all of these answers. Now, the reason that my brother reached out to me is because I do this every single day. As a matter of fact, I own over 100 doors of rental real estate. I've done dozens of loans, researched all of the different loan packages and rates and terms and everything under the sun when it comes to getting loans. And so my goal in this video is to give you everything that you need to make sure that you get the right loan for you and for your family. All that I ask you to do is make sure you smash that like button and subscribe to the channel. And I promise you, this video is gonna guarantee that you get into the right loan. Also, once you watch this video and figure out what loan is perfect for you, make sure to go check out this video, because this video is gonna show you everything you need to know to be able to get approved for a home loan. And that's very important, because if you find the right loan package but you can't get approved, that's gonna be a major bummer. I'm going to explain all of the different loan options and what you need to do to be able to apply for each of them. And then at the end of this video, I'm going to show you how you negotiate terms, rates, and help you understand exactly what you need to look for so that you get a perfect loan and you don't end up getting taken advantage of. Now, I'm guessing most people have heard of conventional and unconventional loans, and I'm gonna explain both of those. However, there are three real options. There's conventional, there's unconventional, and then there are subprime mortgages. Now, I wanna start with subprime mortgages because these are what you want to make sure that you avoid. These were created to help people to get into a home when they were not in a financial state to be able to get into a home. This is for people who have just gone through a divorce or have had major money issues, and yet they're receiving help to purchase a home. I don't know your situation. If you're in a situation where you have a ton of cash and you still want to get a mortgage to keep that cash free, maybe a subprime mortgage would be right for you. However, the reason I tell everyone to steer clear of these is they're going to have terrible terms, extremely high interest rates, and they're a situation that I just don't even want to get involved in. So I'm not going to talk about those, because if you're having to get into those, you're probably in a place where you shouldn't be purchasing a home. So now let's focus in on conventional and unconventional. Now, conventional loans are loans that you get through a bank and they are backed by the bank. Unconventional loans are backed by the government. Now, what this gives the government the ability to do is to give more people loans that maybe can't afford them. However, if you know what you're doing, using an unconventional loan can give you the ability to get an extremely low down payment and take advantage of a couple other great options. And so I'm not telling you not to go the unconventional route. However, I am telling you that overall the unconventional route does have more risk if you're not financially responsible. So you wanna make sure what an unconventional loan entails so that you don't dig yourself into a hole that you can't get out of. Don't get discouraged. Just because you're going the unconventional loan route doesn't mean you're an idiot. As a matter of fact, that is the route I've pushed my brother to use, because it gave him the ability to put a substantially lower down payment down so that he could keep his money liquid, so that he could have money in the bank for his business and to make sure that he's got reserves if for some reason his business has struggles, rather than locking more money up into the loan. So there are lots of advantages to using unconventional, and I'm going to talk about those as I go through all of the different unconventional loan options. Now, the first one I want to start with is probably the most popular. Now, I should probably check my stats on that, but this one is used a ton, especially by first-time home buyers, and that is an FHA loan. Now, an FHA loan is awesome because it gives you the ability to go as low as 3.5% down on a property as long as you are living in that property. On top of that, you can get a 30-year fixed loan and still have extremely competitive rates. So you're in a situation where you could buy your dream home with only 3.5% down. You've got pretty low interest rates, especially right now, and it's a great setup for you. Now, I know a lot of you are saying, if it's such a great option, what are the negatives? You are pretty heavily leveraged. So you're paying a ton in interest. So if you look at big picture, at the end of the day, the less that you put down, the more interest you're going to pay over however long your loan is. Now, a lot of people would say, oh, that sucks, you're paying more interest. Well, it doesn't really suck because a lot of times you can get in a place where you don't need nearly as much money up front and it doesn't affect your monthly payment that drastically. Will you be paying an extra, who knows how many thousands of dollars worth extra in interest? Yes, but if you can get in a situation where you're keeping an extra $15,000, $20,000 in the bank, or heck, even $40,000 or $50,000 in the bank, and it's only going to increase your payment by a couple $100, maybe it's worth it to be able to get into the home that fits your family if you know you can make those monthly payments. The other downside to an FHA loan is what they call MIP. So essentially, it's insurance that you're paying to the bank every single month on top of your mortgage payment. So when you're looking at your monthly payment, you need to make sure that you know what the final number is going to be with your mortgage, which is your principal, your interest, and then adding in your MIP. And with MIP, it is a bummer because with other loans where you have PMI, you get to a point where you no longer have to pay that insurance because you have so much down. However, with this, you have to pay that MIP for the entirety of the loan. Now, I know a lot of people are saying, well, Chandler, is it worth it to go the FHA route? 100% if it works for you. As long as you can make the monthly payments and you've been renting, I think it's an awesome option as long as you don't overspend and put yourself in a situation where you can't afford that mortgage. If you can't afford that mortgage, you're now getting principal pay down every single month. That's money that's getting locked away into that property that you can take out when you refinance or sell the property. On top of that, you're getting appreciation. And remember, appreciation is on the entirety of the building. So if you bought a $100,000 building and you only put $3,500 down in an FHA loan and you're making monthly payments, remember that that $100,000 property should be going up anywhere between $3,000 and $5,000 every single year. So you've got principal pay down and a property that's going up in value. And if you can make that monthly mortgage and it's not any more than what you would have been paying renting, why not jump into it? And usually in a scenario like this, if you've been renting a nice place, it's actually going to cost you less every single month and you're still going to get all of those advantages. So an FHA loan is awesome. Now, the next one is a VA loan, and this is for people who have served in the military. Now, that's not me, so I don't usually talk about VA loans. However, they are probably the best loan package ever, and here's why. They give you the ability to literally put nothing down on your home. So you need almost nothing as a down payment. Now, you'll still have fees to be able to do the loan, except having nothing as a down payment can be a huge advantage if you're tight on money, but you know you're gonna have money and be in a good situation. It's also a great advantage if you're buying like a duplex or a fourplex and you wanna live in a portion and rent out the other portions, so that with no money, you can literally be making money and have a free place to live. So I love VA loans. On top of that, they don't have any kind of mortgage insurance. And so if you're gonna compare that loan to any other loan, I don't think it can be beat, especially because I've seen those come in with extremely low interest rates. So VA loan, definitely approved by Chandler, another great option. The next loan is a USDA or RHS loan. Now, these are loans that I would tell you to stay away for. They're for people out in rural areas. However, they've got a lot of catches to the loan. Now, you can get into a house with almost nothing down. However, you are going to have crazy mortgage insurance. You're going to have prepayment penalties so that if you ever want to refinance, you've got to pay these penalties. You've got all kinds of different junk that's involved with these loans. And so the terms just kind of suck, other than the fact that you don't require any money to get into them. So if you're in a scenario, again, where it makes sense and you can make the mortgage and you understand all of the penalties and fees and everything else involved with these, then maybe they'll work for you. However, it's something that I personally probably wouldn't mess around with. Now, I'm sure there are other unconventional loans. However, those are the main ones that most people use. And as you can see, I think a lot of those loan options could be incredible for you. You just want to make sure that you find the right one. And later in this video, I'm going to show you how to decide if the rates and terms and everything else are a good fit for you so you don't get taken advantage of by the bank. All right, now we're going to jump into conventional loans. And remember, conventional loans are backed by the bank. And so they are purely a bank loan. However, within the conventional loan niche, there are conforming loans and non-conforming loans. Non-conforming loans are like jumbo loans. They're on bigger purchase price items, and they don't conform to the requirements made by Fannie Mae and Freddie Mac. And so conforming loans are going to give you better interest rates and usually better terms and the option to put a lower down payment on. And honestly, most people don't even know the difference of these, because anytime you're going in for a normal home that isn't like this mansion, it's going to be a conforming loan, which is going to give you awesome interest rates. Conventional loans are awesome, and they give you the ability to go as low as only 5% down when purchasing a home that you're going to live in. The only thing you need to keep in mind is you will have to pay private mortgage insurance, or PMI, which is what we talked about earlier. The difference with private mortgage insurance compared to MIP, like you had on an FHA loan, is once you get to a certain point. So once you've gotten 20% down in the home, you no longer have to pay that mortgage insurance. So at some point, you won't have that bill anymore. The other thing that's really cool about these loans is the interest rates are extremely competitive. So you should be able to get a very low interest rate. Now, after this, conventional loans, just like any other loan, get to a point where the rates and terms and everything else can be all kinds of crazy. I mean, you can change your down payment, they can change the interest rates, they can change whether it's fixed for 5 years or 30 years or 5 years and then it changes every year, or 5 years and it changes every 5 years. Those are called ARM loans. And an ARM loan is cool because it gives you a lower interest rate, and a lot of times you can work a lower down and a lower interest rate. However, after 5 years, then your interest rate can change. And so if interest rates go way up, you can get totally screwed on an ARM loan. Now, a lot of you are saying, well, Chandler, is it ever a good option to use an ARM loan? Yes, it can be a great option if you're only planning on using that loan for 5 years and then refinancing, or if you're very confident that interest rates aren't going to go up, which I've never met anyone that is 100% confident in that. However, if you know something that we don't know, again, it could be a great option for you. I talk very negatively about these ARM mortgages. However, I buy commercial property, and that sometimes is the only option. And so I actually own property right now that is on an ARM. So it's not something to lose sleep over if that's the only option that works for you and you understand the risks. All right, so we've covered all of the loans, but now we need to get into the nitty gritty. And that is the combination of all of these different options put together and how they affect your end result of what loan you have. And what I mean by that is you've got interest rates that are going to be different. You've got down payment that's going to be different. You've got the length of your term, whether it's a 15, a 30, or a 50-year loan. You've got fees on the upfront. You've got loans that can change rates as time goes on. And what's interesting is every time you get something added that looks advantageous, it's usually affecting one of these other things. And so you need to know exactly what you want for a loan and figure out what you have to use. For instance, if you've got a lot of money to put as a down payment, it will save you money to put more down. However, if putting more down puts you in a tricky situation, it's not worth it if that leaves you cash poor and you've still got a loan. Even if you've got lower interest rates, who cares if you don't have any money in reserves and you end up getting screwed? And so I'm going to show you how to analyze all of these different terms and everything else so that you can put yourself in a place where you know exactly the kind of loan and the terms that you need so that you're set up. So the first thing you need to understand is if it provides you the best interest rate ever, that doesn't always mean it's the right loan for you. The same way, if it provides the lowest down payment for you, it's not the best loan, because anytime you're doing a lower down payment, you're going to have a higher interest rate. However, anytime you do a bigger down payment, you're going to have a lower interest rate. Anytime you have a shorter term, for instance, if you go from a 30-year term down to a 15-year term, your interest rate is going to go down. And a lot of times, even your fees will go down. The same with one of these ARM loans. If you do an ARM loan where your rate changes after 5 years, you're going to be able to lock in a crazy low rate in comparison to a 30-year fixed. However, keep in mind after 5 years, then that rate is going to increase. As a matter of fact, sometimes they'll put in the terms that regardless of where the prime interest rate is, your interest rate has to go up and it cannot go down. And so you've got to take that into consideration when you're looking at these loans, because everything has an impact on other factors. Now, before you ever lock in a loan, these are the things you need to make sure that you get from your loan officer so you know exactly what you're signing up for. First off, you want to know what the interest rates are. Second off, you want to know what your down payment is, so how much down you need. Third, you want to know what the terms are as far as how long the loan is, whether it's 5 years, 15 years, 30 years, 50 years, how long is your rate fixed? And then what happens after it's no longer fixed? Is it the end of the term, or is it an interest rate that can change? Then you want to know if you're going to have any kind of PMI or personal mortgage insurance, whether that's MIP, PMI, whatever it is. You want to see if there's any other monthly fee that you're going to get hit with as insurance on that loan. You also want to make sure that there aren't any other crazy fees on your closing costs. So pin down exactly what your closing costs are going to be on top of your down payment. Finally, you want to make sure that there aren't any prepayment penalties and you understand what your freedoms will be when it comes to refinance. And what you can do is when you're comparing loans, you can get the details on all of these things. So you can compare a 15-year to a 30-year. You can compare one of the ARM loans to a 30-year. You can compare a lower down payment to a higher down payment. And this is what your loan officer is getting paid to do. So get all of them in front of you and figure out what's going to work best for your family. Now, here was my advice to my brother when he was deciding what to do. I told him, look, are you planning on staying in the home for longer than 5 years? If you are, and you know you're going to be staying in the home for a long period of time, then you probably shouldn't do one of the ARM loans. So with the term, you need to figure out what's going to be best for you depending on how long you're staying in the home. Now, if you talk to a Dave Ramsey, he's always going to say, do the shortest term possible on a fixed rate.
You people that are calling me out.
I really strongly disagree with this because I'm a big believer of keeping reserves. I think you should always keep enough reserves to where if crap hit the fan, you could pay your mortgage and all of your living expenses for at least 6 months. So use this as a requirement to figure out which loan works best for you, because you don't want to put a ton down to try and get ahead if you don't have reserves. So make sure you're keeping a good amount of reserves and then just play around with it. In my personal opinion, the best loan is going to be a 30-year fixed loan. The reason I love this is you can lock in a super low interest rate. You can know that that term is fixed and you're in a situation where you know exactly what your payment is going to be every single month. Now, if you have the money for a bigger down payment, send it. However, my one argument would be if you've got a ton of money and you've got enough for 20% down on your home, why not put a lower down payment on your home and then use that extra money you would have put in a down payment in an investment property? And this is a little bit of a higher level technique, but just think about it this way. If you're in a place where you're only paying 3.5% interest and then PMI, so essentially it looks like maybe a 4 or a 4.5% interest rate, that you're saving paying that interest rate by having that money in your home. If you can make a 10% interest rate somewhere else, why not pull that money out and use it to make 10%? Now, you might be paying 4 or even 5% over here, but you're making that 5% back to pay it off, and you're making an additional 5%. So you've got to sit back and look at your scenario. The biggest piece of advice I can give you is I always believe it's better to own than to rent, because you're going to get principal pay down, you're going to get appreciation on that property, and you're going to have something that is yours, something that you can live in, that you can raise your family in. Now, I really hope this video is going to help you to find the perfect loan for you and your family. If you enjoyed it, please push the like button, subscribe to the channel. And again, if you want to learn how to get approved for a home loan, go down in the description and push the link on that video, and it will help you learn everything that you need to know to make sure you not only get approved, but then by using this video, you pick the right loan so that you can get into your perfect home. Now, with all of that being said, again, push the like button, subscribe to the channel, and I'll look forward to seeing you in my future videos where my goal is to help you make smart financial decisions and build a huge passive income. Thanks so much, guys. Have a great day.